what you have here might be a little bit different, but what you will see is one box with illustrations. And if you just click on GPS Life Product and Annuities online version, I always like to use the online version, and there are a few reasons for that. We can save cases in the cloud, so in the event that I have an issue with my computer, I'll be able to still work and access cases that I've worked on. So what we'll see is it opens up in a new window eventually, and GPS will open up there. It usually is not this slow for me, but of course it is today.
I just tell them the truth. You hit your computer with a hammer right before this started.
I absolutely did. You know, I was tired of it, and now wasn't happy on a Monday, and my computer is sort of giving me payback. Well, here we're going to get to the initial screen. So a couple of things we'll want to talk about here. To do any new case, all you have to do is go to cases in this upper left-hand corner, go to new. If we do new in-force, it's going to open up a screen that would let us download an in-force case. A couple of things about in-forces: we cannot run an in-force on a case until it is more than a year old. So any case that was written less than 12 months ago, we can't do an in-force on. So just keep that in mind. And hold on one second. We've got Stephen coming in. All right, perfect. But for any new case, essentially what we want to do is go to cases, go to new, and here we can choose what options, what we want to choose to run. You will notice, for instance, yearly renewable term, we have 2017, we have 2007, we have 1994, we have 1997. So we do have some older series products in here. You know, as for Whole Life 99, we have the 2016, well, actually 2014, actually all the way out, 2006 to 2021. That's in the event we're looking to just do recreations of illustrations, but those can't be sold. But if we actually choose a state, you'll see all of those go away, and we just have what's available for sale. And we're going to start simple and start with the Guardian level term. We would just click on Guardian level term, either double click on it or hit new case. And this will actually get us to the initial screen. Now this first insured page is going to be pretty self-explanatory. You can choose the issue state, obviously put in the client's name, risk class, whether or not they are a smoker or not a smoker. Now, anytime we're going to talk about non-smoker, that is our version of standard non-tobacco. So that would be our non-smoker rating. If we go to standard, we would only use that if we do have a smoker. So for instance, if I try to calculate this, just click calculate up here, and I have it as standard and no tobacco, should give me an error message, just letting me know that no tobacco is invalid with standard. So what I would do, I would only use standard when we have a smoker, and that will let me run it. Now, if I just go back to second best, for instance, and change this to no tobacco, that would be second best rate class. We have elite, we have preferred plus, we have preferred, we have the standard non-smoker, and then we have the standard smoker, as well as any ratings available on our term cases. That is one additional rating on term that isn't available on whole life. that elite rating isn't available on whole life. So this second best rate class would pretty much go down to, probably would go to a preferred plus, all things considered, just depending on the series of the contract. But this is going to be pretty self-explanatory. Owner type isn't going to make a whole lot of difference in the illustration itself, just like tax bracket isn't going to make much of a difference in a term contract. Could potentially make a difference in a whole life contract, but we'll get into that. So it doesn't really matter what we put there. Extra premium, that's if we have a flat extra. So there are permanent flat extras that would be on a contract for 20 years, and then there are temporary flat extras that we would be able to choose the number of years they're on. And an example of a temporary flat extra could be a 27-year-old that may have a bad driving record in the past, and they have a $3 flat extra per thousand for 4 years. And all that means is there's a $3 additional charge per $1,000 of death benefit they're purchasing for whatever number of years. Like I said, if it's permanent, that's going to fall off after 20 years. If it's temporary, it's going to fall off in whatever number of years we choose. And all we would do for that is an amount. Let's say it's $3. We would just put a 3 there. And from 1 through max, let's say it's for 4 years, we would do 1 through 4, and we would have that flat extra for 4 years. I'll actually leave that on for now. Going over to policy design, this is pretty much going to let us know everything we want to choose for this guaranteed level term. So we can choose 10, 15, 20, or 30 year. So we do offer up to a 30-year contract, 30-year term contract. Let's do 30 for this example. Face amount option. We can either choose to do a base face amount. So that's if I know I want $250,000, $500,000, $1 million of death benefit. That's where I would choose that. Or on the other hand, if I know I want to spend $10,000 a year, how much death benefit can that 10K get me? In this case, we'll just specify base face amount and $1 million. This right here, increased space for banding, we always want that checked. And the reason for that is it's actually going to, depending on the cost per thousand, think of it like buying in bulk. You have certain bands in which the cost per thousand is going to go down. So if I buy $1 million, the cost per thousand on that $1 million is going to cost me less than if I bought $995,000. So if I have increased for banding and I put $995,000 in there, it will let me know that based on the premium being paid, if we increase the face amount to $1,025,000, you'll actually be paying the same amount that you would have for that $995K, and you just get that additional $30,000 of death benefit. So we always want that checked here. Waiver premium. We'll have waiver premium. We'll simply waive the premium where Guardian covers it for you through the end of the term contract. And that is for simple waiver of premium. Okay. Now, policy split for waiver limit. Usually not going to use that. Anytime you need to use that, you're going to either reach out to me or you're going to reach out to Life Product Support, because they're going, if you reach out to me, I would send it to Life Product Support for you. That's something that you and I are not allowed to run because it does need an override, and that really comes down to waiver limit. So let's assume somebody has a $5 million policy with waiver. we have a waiver limit of $7.5 million. So you can't have waiver on more than $7.5 million. And if we're purchasing another $5 million of death benefit and we want waiver on that, we are only allowed to get waiver on $2.5 million of it, because with the $5 million that we already have in force, that will get us to the max limit of $7.5 million. So what that's going to do is run two policies for you, but it's going to take into account that banding we talked about right here. Because if we did a $2.5 million policy and we could only get waiver on $500,000 of it, we're paying a lot more per thousand on that $500,000 than we would have been if we were doing 2.5. So that will allow us to really get the lower premium on that $500,000 that's going to have that lower cost per thousand on that $500,000 that has the waiver. So again, if we ever have a question about waiver and what's allowed and what's not allowed and what we can and cannot run, please feel free to reach out to me. And if we ever do need to use that waiver, that policy split for waiver limit, we will get that for you by going to Life Product Support. Waiver Plus, it's like waiver, but different. Does have a higher premium, but there's a reason it has a higher premium. Like waiver, if we are disabled in year 15 of this 30-year term, for the rest of those, for the remaining 15 years, it is going to cover our premium for us. So we don't have to pay another term premium for the rest of that period. But if we have waiver, something different happens in after year 30. Whereas here, after year 30, our contract goes away with Waiver Plus, as long as we have extended conversion rider, and we do need both of these attached on a contract to get Waiver Plus. But if we have Waiver Plus, what's going to happen in year 30 is my contract will convert to the longest premium paying a whole life contract that we have on the books, and waiver will carry over. So if I chose this one, year 31, it switches to a whole life contract, and this, based on what we have available now, be the whole life 121. We'll get into the whole life contracts in a bit, but and waiver would carry over, so I would never have to pay another premium, and I would then have a permanent contract that would receive cash value, would receive dividends, and I wouldn't have paid $1 for it because of Waiver Plus. Like I said, this does have a higher premium, but for many it will actually be worth it, and it really comes down to what your client is looking for. There isn't any right or wrong waiver. It's really going to be based on the client, how they feel about waiver, how they feel about everything long term. And what you're going to notice is with a lot of our riders, even with whole life, even with term, but even more so with whole life, we don't have a one-size-fits-all mentality. We have a ton of different riders on there. We have a ton of different ways for the client to really make the contract their own based on their objectives. My objectives are going to be different than yours, and these riders allow us to sort of hone in more on what our objectives are and make the policy our own. But like I said, Waiver Plus is going to allow us to eventually convert to a whole life contract. Bless you. With waiver being carried over and no additional premium. Like I said, prerequisite of that Waiver Plus is going to be the extended conversion rider. This is an interesting one, and this is one that I would say also gives us a nice competitive advantage, as does that 30-year level premium term. And that extended conversion rider is going to change the conversion on our contracts from 5 years and is going to push it out all the way to the end of the term. So essentially with this 30-year term, instead of just having 5 years of conversion, if I have this extended conversion rider, I can convert it all the way out to year 30, which is a super long term period, but on top of it, also a super long period in which we can convert. And that sort of comes back down to potentially changing objectives. I may not be 100% sure that I'm going to convert within the first 5 years. I may not be able to convert within the first 5 years, but I know by year 10, by year 11, year 12, I want to start converting pieces of this $1 million. That extended conversion rider is going to give me the ability to do so. Many of our competitors don't even have a 30-year term available, let alone have an extended conversion rider on a 30-year term or even on a 20-year term, which most do have. Most are going to have conversion of anywhere from 5 to 10 years. We can push that out all the way to the end of the term. And again, waiver plus and extended conversion rider. You can't have waiver plus without extended conversion rider, but you can have extended conversion rider without waiver plus. All right, and I may have confused some people there. I know I am going pretty quickly. That's the New Jersey in me, the East Coast in me. So again, if any questions come up, please refer to the chat. Do not hesitate. My direct line is there. My email is there. Do not hesitate to call, text, or email me. Care conversion option. That's a newerish rider, and it's an interesting one because really long-term care has become more of a talking point. And we have a great long-term care rider. We'll talk about that in a little bit when we get to our whole life, to our permanent contracts. But the care conversion option rider is going to, right now when it's issued, is going to underwrite us not only for the mortality of the death benefit, but also the morbidity for the long-term care rider there. So it's actually going to be underwriting us for both death benefit as well as long-term care. And what this does is will allow us within a certain period of time, if we were to convert pieces of our death benefit, to convert it with long-term care without any underwriting. So on its own, 5 years conversion. So I'd be able to convert any to all of this $1 million to a whole life contract and add the long-term care rider on it without any underwriting. If I have the extended conversion rider checked, then that 5 years is increased the duration to 10 years. So if I've got extended conversion rider and care conversion option rider, and in year 10 I decide to convert all of this 1 million, I can then convert that full 1 million with the maximum long-term care rider, and that is without underwriting. So again, that's a term rider that not many, I don't know if any of our competitors really have, and it's just another reason to throw conversion to convert a contract. You've got that long-term care in addition now to that increasing death benefit, in addition to that increasing cash value. So that's going to be huge. The accelerated terminal illness rider, this was checked by default, and that's pretty much something you're going to want to put on everything. And what that'll do is, obviously in a rider we'd never want to use, but if we do use it, it could make a huge difference. But what it'll do is, if we find out the insured is terminal and is thought to pass away within the next 12 to 24 months, we can take a portion of that death benefit and take it up front and accelerate it while we're still alive. And that would be to pay any care expenses, any medical expenses that have come up. So, let's say we want to take $100,000 of it. We'd be able to pull $100,000 of this $1 million. The $900,000 would still stay there for our beneficiaries. The $100,000 could pay for some medical expenses we have. Whole life purchase option, another nice option where we can just have certain option dates to purchase additional whole life without underwriting. So it's kind of like term conversion, but in this case, we're going to have specific amounts that we can purchase, and it's going to be in specific years in which we can purchase those and make those purchase options. And it's pretty much going to be years 3, 6, and 9 that we can make those additional purchases. So, I may be able to purchase an additional $100,000 of whole life in year 3, in addition to, any type of term conversion I may do in that period of time. Okay. Oh, and just going back to policy design, right here, premium mode, take that off. Premium mode, we have annual, semi-annual, quarterly, and Gardomatic. Gardomatic is what we call our monthly. By and large, GOM or monthly and annual are the two more popular options. We stray away from semi-annual and quarterly, because those have the greatest percentage of lapses, and B, they're actually going to cost you more. When we pay something annually, we have no modal premiums. So you pay just the premium for the death benefit. When we pay semi-annual, quarterly, or Gardomatic, we do have a modal charge on top of it, so just a little bit higher, and so we're paying a little bit more per year cumulatively, sort of like our car insurance. If we pay it all up front for the year, it's going to cost us a little bit less than what it would have cost us to pay it monthly. So same idea there, but GOM is going to, of these 3 options that have those modal charges, GOM is going to have the lowest modal charge there. So, like I said, honest and GOM we can also sort of do on monthly bank draft, which is nice. That's why, for the most part, we're going to want to run most of our contracts at either annual or Gardomatic. I'm going to run it at GOM now for that. And output design, really just going to give us a couple of options here. For instance, term array, if we have term array checked, it's going to let us be able to see what the premiums would have been if for a 10-year, 15-year, 20-year, 30-year term at that underwriting class, or we can actually choose multiple underwriting classes if we want to potentially see, all right, this is what it is at Preferred Plus, but if perchance you get Elite, it could go down to this, but let's run it at the one underwriting class. Once we're done there, hit calculate. And there you go. So right here quickly, we can just look at what it costs us. Remember that 4-year flat extra? At $3 per thousand, an additional $3,000 of the premium, and then it goes down to the $1,230. After we get out into year 30, you'll notice it shoots up because it essentially is becoming a 1-year renewable term. Definitely probably don't want to pay $28,000, $29,000, or $34,000, but in the event, right out here, this is helpful because if your client has this 30-year term and they find out that they maybe won't be around for too much longer, then paying that $29,000 may obviously make a ton of sense. Just because they're paying that here, they were to pass away somewhere around here, they still get that $1 million of death benefit. Now going to the illustration, right here where you see the illustration with the red and white Adobe PDF symbol, if I go to cover page, it's going to go to the PDF for me. And here I can see what the actual illustration, the compliant illustration looks like. And if I go to level term report, same thing we saw right up here. And now we'll go to term array, where it actually lets us see what is the premium going to be for each. And keep in mind that all of these premiums have that extra $3,000 on there. So that 10-year term would only be $360 for 10 years. This would be $450, $620, and then $1,230. So term is going to be fairly inexpensive for somebody that's going to be for sort of a healthy adult. And going back here, we'll just remove that flat extra. If we want to remove that, just clear. All right, so in a nutshell, that's how to run Guardian level term. That's pretty straightforward, pretty easy. Now, nice tip for when we're running something, if you go to add plan, and I can either choose new business plan or copy of the current plan. If I do copy of the current plan, what it does is suddenly going to just create a carbon copy. You'll see up here we have these this ribbon across the top that we can look at what our cash value is, what our death benefit is at certain years and at certain ages. Nice, easy way to just compare two contracts, just see sort of how they look, but we'll want to change this. So if we click change, we actually change the contract, and we're going to go to the 99. But real quick, while we're there, I'm going to just go to whole life. And let's go through sort of some of the pluses and minuses of each of these contracts. We've got, right now we have 2 core products. It will be 3 in a few weeks. But right now we have Whole Life 99 and Whole Life 95. We also have Whole Life 121. If you recall, I brought up Whole Life 121 when we were talking about the waiver plus, because that's the contract that you'd be able to sort of convert into at the end of the term. And let's talk about what the strengths and weaknesses are of each of these contracts. Whole Life 121, starting there, it's payable to age 121. You don't see it here, but that's going to be payable to 121. It's going to be our lowest premium contract. It's also going to have our lowest internal rate of return, our lowest dividends. So that's going to be the contract for that client that might be a little bit older, doesn't care about cash accumulation, and just wants the lowest cost of entry into plain vanilla whole life. That might be right for an older client that may be too old to get some of these contracts here, or wants to just go in for a very low premium. Whole Life 99, this is our most popular contract. It's the highest percentage of our contracts sold. That's going to have our second lowest premium. This is also going to have our highest long-term internal rate of return. It's also going to be the contract that works best with PUA, which we'll get into in a bit. This will be payable to age 99. It's going to have the most flexibility for what's called an offset to short pay a contract and to have the premiums paid out of contract values. Our whole life 95, that's more of our higher early cash value. Little bit higher premium than our 99, payable to age 95. It's going to have the highest internal rate of return through about year 10 to 15, depending on the age and rate class of the person. And it's going to get us some cash value available right up front. So for potentially a small business case or somebody that wants to have a little bit higher cash value in the first 10 years, this may be the way to go over this. Whereas this one, if we want to look at higher cash value, 15, 20, 30 years out, that's the 99. Life paid up at 65, that is pretty much what it says there. It's going to be payable through age 65. That's used a lot for cases in which we are looking for retirement supplement. Doesn't work as well with PUA as these other two contracts, but it is going to be contractually guaranteed at age 95. So contractually, if we purchase $1 million of insurance, guaranteed we will have $1 million of paid up insurance at age 65. Again, since there are zero premiums going forward, it works well for being able to pull money out at age 65 for retirement purposes. Guaranteed issue executive strategies whole life, that's going to be more of a guaranteed issue contract. We're not going to really get into that. Executive strategies, we're not going to go into detail on that, but this is a very high early cash value. It's an awesome product, but it does have high minimums. So for single life cases, we have a $100,000 premium limit. So if I wanted to purchase this executive strategies whole life, I'd have to pay $100,000 of base premium and at least $250,000 death benefit, but I'm getting around $90,000 to $96,000 of that $100,000 I paid in available in cash day one. So maybe not the right contract for me, but for a higher net worth individual, for a business owner, for somebody that has a successful business that wants to have some whole life, but doesn't like the fact that they'll potentially be making a $100,000 premium payment and not have a whole lot of cash available up front. This one here will be perfect because, like I said, anywhere from 90,000 plus, close to 95,000 in most cases, of that cash value is going to be available for them right at the beginning of the policy. So they get a nice way of getting that death benefit, but showing an asset on the books. I do like the product, but it's one of those products that it's a very niche product, and we do have quite a few niche products here. 20 pay whole life, like the 65, but payable for 20 years. So these two products right here, scenarios in which they would be used is potentially juvenile cases, somebody that does like the fact that they're going to have contractual amount of time in which they have to pay the contract and no longer. Juvenile college planning, sort of like the 65 is awesome for that retirement supplement. The 10 or the 20 pay would be awesome for, an alternative to 529 plans, or in addition to a 529 plan, to be able to put a ton of money away into a whole life contract for a child and potentially use it to cover college costs at some point. Another nice use scenario for 10 pay would be somebody with a very stressful job that has a low time horizon for which they can actually handle it. Like, let's say a hedge fund manager that may be working hard those, for 10, 15 years and then just retire early, or an athlete that, a baseball player or a football player that is just looking to put a ton of money away while they have those high paying contracts, to have that there after they retire, and just have that backup there and have some additional buckets of money. Or anybody really that just likes the idea of paying in for just 10 or 20 years and knowing they will absolutely never have to pay money into this contract again and have an increasing asset. We're going to start off with the whole life 99. And in this one, we're going to just run a couple of simple cases. Again, we're using same parameters, same 35-year-old male. I have pulled out that extra premium for this case. Tax bracket, that 28% here could potentially play a role depending on what reports we choose or if the contract is a MEC. Policy design here is going to look a little bit different. We have a few different dividend options. By and large, most of the time we're going to be looking at paid up ads. Base amount option, we can do a couple of different options here. So specified base, same way if we're doing $1 million, or specified base premium, same way if we're doing that 10K. Solving for minimum non-MEC, that's going to just give us the minimum face amount to not MEC a policy. Or solving for maximum face amount, the maximum face amount that we can get while keeping some of the solves that we do down here. So here I'm going to just do specified base face. I'm going to leave it $1 million. Paid up additions rider. So that's a huge rider for us because our flexibility is really just about second to none. If we do specified rider premium, we do as little as $250 in there a year. What this is going to do is give our clients the ability to overfund their contract with paid up additions without any underwriting, within some guardian limits and within MEC limits. So really what happened is early 80s, what we're looking at is people were just buying tiny policies and throwing a bunch of what's called paid up additions into the contract. And that was creating a ton of cash value early on and a ton of compounding and growth going forward. And they were getting huge internal rates of return. Government saw this, the Internal Revenue Service saw this and did what's called created a 7-pay premium test and a modified endowment contract. So if a contract fails a 7-pay premium test, it no longer meets the definition of life insurance, and it will then potentially be taxable. So it's going to be last in, first out. So all of our growth is going to come out first, which would create taxation, whereas how it usually works is our growth comes out last on these contracts to avoid some taxation. But if we do 250, we'll fall within those MEC limits and don't surpass them, or guardian limits, we can put more money into this contract without any additional underwriting. We have very liberal rules for it. Years 1, it's going to be 10 times base premium. Years 2 through 10, it's going to be 3 times base premium that we can put into this contract. In years 11 on, it's going to be 1 times base premium. And just keep in mind, that 3 times base premium in most cases would MEC a contract. So we fall definitely within those MEC limits. Premium payment option, full pay. we'll leave it as full pay. We'll go back in and change it to some of the other options, but we do have premium offset or scheduled pay. Premium offset is if we don't want to pay premium out of pocket and we want it paid out of contract values. And we'll leave this as GOM now. Riders and features. I'm going to go through these quickly. Waiver of premium. If we are disabled, it will pay the base premium for us for as long as we're disabled. As long as we're disabled prior to age 60. If we're disabled after age 60, it'll pay to age 65. By age 65, this rider falls off because it assumes retirement. So this is really just to protect us. So think of it as a disability policy for our whole life policy while we're working. And most younger people, I would say we definitely want to put it on. Accidental death benefit, that in the event of passing away due to an accident, this will give us an additional death benefit. Not a rider we sell a whole lot of just because a lot of times guaranteed issue policy and group life policies are so inexpensive for accidental death benefit. We don't sell a ton of it, but the option is there for that, for that person that may travel a lot and is thinking, just in case I pass away due to an accident, I'd like to have the additional death benefit there. We can always throw that on. Dual guard, another one that you're not going to see a whole lot of, at least not yet. And that's if I, for instance, purchase a $1 million policy and my wife is also underwritten at that time, and she will be what's called the designated life, and she would be the beneficiary. I pass away, she would get $1 million of death benefit from me. She can then use a portion of that $1 million to buy life insurance without having to get any additional underwriting. So that was used in estate tax purposes. Could also be used in cases in which I know I want a survivor benefit, but I'm not 100% sure that I would want a legacy benefit. So then my wife can actually choose to just take a portion of that $1 million, or all of it for that matter, depending on how much she can purchase, and live off of whatever she keeps and throw a portion of it into a whole life policy for our children, or a charity of her choice. So that's going to be the dual guard. 10-year renewable term rider. It's going to be a 10-year renewable term. Anytime you see a yearly renewable term or RPR or YRT, it's going to be an increasing premium contract. This is going to be available for 10 years. It is going to increase the premium for 10 years. It is convertible for 10 years. This is a nice option if we have a short-term liability that we may want to cover for pretty inexpensively, or we want super inexpensive term insurance to be able to convert within 10 years. That would be the option there. Lifetime protection builder, another term rider. This is going to be a reducing term, so it's good for 15 years. Let's say we put in $900,000, doing 900 just because for easy math. Every 5 years of it, a third of that 900 or a third of that death benefit will fall off. So year 5, $300,000 of my 900 will go away, and I have an option to potentially take that and turn it into $300,000 of whole life. So this would be a case in which we have somebody that may have sort of a longer term liability, or the potential to sort of exercise some of those options in years 3, 6, and years 5, 10, and 15, or maybe one of the other calls we'll go over sort of a mortgage replacement strategy by using this lifetime protection builder. Again, not one of these you're going to see a ton. So far, looking at the four we went over, they're sort of niche riders. But again, remember what I said, have a ton of options to really just meet everybody's objective. Now here we're getting into the riders that are going to be a little bit more prevalent, a little bit more used. Guaranteed insurability option. Think of it like that guaranteed, that whole life purchase option we had on term. This is going to give us a couple of different ways of getting more death benefit. Here we have GIO Plus and GIO. I do GIO, again, years 3, 6, and 9. I can just use it to purchase additional whole life insurance. If I have GIO Plus, that'll give me up to 8 options at certain years to purchase more whole life insurance. So that's used a lot for juvenile policies. Let's say they have a 10 pay on a 5-year-old. By age 15, they're done. All the premiums are paid. But the issue is we haven't really given them a real option to truly increase their whole life by doing this GIO amount at age 25 through age 46 every 3 years. So 25, 28, 31, 34, 37, 40, 43, and 46, those 8 options, they could potentially purchase more whole life without underwriting. So used a lot for juvenile policies, used a lot for younger people that just want to guarantee their insurability and guarantee their ability to get more of it. Let's assume a doctor that is in his residency and not making a ton of money, but knows he's going to go into private practice and be making a ton of money in the next 5, 10, 15, 20 years. GIO is going to be awesome for that, for that doctor. Going into enhanced ADR, no cost rider. Pretty much you want to put this on almost every contract. Like that accelerated terminal rider that we talked about on term, this is going to cover you in the event of you having a terminal illness, but it's also going to cover you in the event of a chronic illness. This is a no-cost rider, so anytime we're running a contract, we'll want to put it on there. The only time we don't want it on there is A, if they can't get it for any reason, because even though it doesn't have a premium, it is going to be underwritten, or if we're going to use the long-term care rider. Long-term care rider, day one is going to let you use 90% of your death benefit. It's going to let you accelerate that over 50 months. It will cover you in the event of a true long-term care. It does have a premium. Major differences between EABR and long-term care. Keep in mind that I said chronic illness, so it would have to be an illness from which we are not thought to get better. Long-term care rider. It could be something that we think is going to get better. So I fall outside on the ice that is in my backyard because I didn't drop enough salt back there, and I break a hip, but they think I'm going to be better and I'm going to be back 100% in 2 years. Long-term care rider will cover me. EABR will not. But if I get a cognitive impairment like Alzheimer's or dementia, both will cover me just a little bit differently how they'll cover me. Long-term care rider also is going to have a premium credit, so I don't have to pay premiums while I'm on claim. EABR doesn't have that, so there are definitely some nice options there. Index participation rider, one that I think we should be putting on everything, at least at 0. We can choose index participation rider from 0 to 100. All this is going to do is give us a little bit of market exposure. So it's going to take our non-guaranteed cash values. We're not messing with those guaranteed values, just the non-guaranteed values. We're going to take those and link them to the S&P 500 index and depending on what the S&P did from point to point, it will adjust your dividend up or down. So it's like taking the best of an index product, but including the guarantees of a whole life contract and throwing it into one contract. If we put it on at 0, it costs us nothing. We can change that from 0 to 100 at any point. And if we calculate, and oops, waiver premium. Good thing it did that for me. We also have waiver specified PUA. If we hit include, it'll, in the event of a disability, it will also cover our PUA premium. In this case, that $250 we put in there. We hit calculate. There we go. Going over the ledger statement, you'll see we're paying about $16,000 in premium. That's with waiver. You see the breakdown here of what each of the riders that we have on there are costing you. That 7-pay premium, remember when I talked about max, is right here. So this is pretty much telling us the maximum that we can put into this contract without without turning it into a mech. And this is giving us the breakdown of what we would be paying annually versus what we would be paying monthly. And now let's just assume we want that million. We like the whole life contract, but maybe if I could get this premium down to $8,000 for $1 million, that would be the best option. For this one, we're going to run this pretty quickly. We'll expand upon it in some multi-use scenarios. But remember, all I did was add plan, copy of the current plan. I'm going to delete this for the time being. So I've got 2 identical plans here. If I go to policy design, let's assume I want $1 million of death benefit. I'm willing to give up some cash value, but I just need to get that premium a little bit lower because I can't afford $16,000 right now, and I can probably do about half of that. We go into policy design. I didn't change anything else. We go to what's called level Q term. This is going to create a hybrid whole life term policy. So you can have a portion of term and a portion of whole life. For the most part, we want to do this at around a 50-50 blend because this does bring in a little bit of dividend sensitivity. We do have increasing cost of term here, so we want to be cognizant of that. Not do something that, they're going to be potentially underfunding and could fall apart for them. So in this case, the base space, that's going to be the amount of the whole life. I'm going to make that $500,000. And the total benefit, I'll make $1 million. Let me add on a 0. PUA type, we'll want to leave it as scheduled PUA. And PUA premiums, in this case, we'll want to do solve for minimum premium. Because that way the computer is telling us how much PUA do we need to keep this death benefit, this $1 million death benefit in force. The parameters are, I can either buy out the term, which is going to cost me more, or I can maintain the coverage to age 104. So if I did 50, that simply means it's going to save it for the next 50 years. So to this client's age 85, if I put an A in front of that, that's the same thing, but it's just letting me know the age. We're going to leave it at that 104. So keeping it out to basically past age 100. Interest rate current -1. I always like to change this to current because current -1 is just assuming a lower dividend, and it's assuming a 1% lower dividend. Historically, we're at the lowest dividend interest rate we've been in since like 1976. So I think going down so much lower on the dividend just is a little bit more conservative than we need to be in this current dividend interest rate environment. I'm going to leave everything else the same. I haven't changed anything else. Calculating the same contract, we're going to see a couple of extra columns. Well, not extra, different, let's call it. So going into the ledger statement, so about half of the premium, because we're only doing about half of that whole life amount, $1 million. The other half is term, and notice what happens here. This is the face amount of 1 year term, and as we get a dividend, and as we pay those paid up additions, we actually reduce the term to eventually it going down to 0 in this case, because this is a younger client, fairly inexpensive cost of term, and we get rid of all of that term, and then we start seeing the death benefit go up. So a nice way of getting a little bit additional, getting a little bit more death benefit for a lower premium when we really care about that death benefit. But looking at the cash value, looking at how the net cash value is impacted, obviously we're paying a lot less, but we also have the cost of insurance to contend with. We have less than half of the cash value at age 85 or at age 65 or 75. So that's going to be the difference there. But if we wanted to see this side by side, another really cool tip to have here, comparison. We'll want both. We'll want whatever we want to include in here, include with output. So this is going to be a nice way if you want to show 2 or 3 options to your client and you want them to choose either A or B or A, B, and C, and make it just a nice, easy choice, and give them the ability to see all and both of these side by side. That's where the comparison comes in. We'll want to make sure this status says include with output for both, because it needs to come, the output being the illustration, so we need to have that for each of these illustrations for it to be compliant, but gives us this really nice presentation here, policy comparison for clients, and right here we'll see at certain benchmark years, year 10, 15, 20, and so on, just the comparison of what we've paid in cumulatively, what our guaranteed cash is, what our total cash is, and what our death benefit is. So going out here, just to sort of break it down and look at and choose enough years for this, but just looking at year 40 in option 1, in which we had all the full $1 million, we paid about $622,000 into it. We have about $1.5 million and $2.2 million in death benefit. Whereas here, we paid about half, $318. But as far as net cash, we only have about half, and net death benefit, again, a little bit less than half, but we paid a lot less. So we have some flexibility here to really run these in a few different ways. And you'll see Q-term, once we talk again, Q-term can be used, on the whole opposite side of the spectrum, which we'll get to. But it gives us a pretty nice idea of sort of some things we can run. So I know we went a little bit over, but any questions?
No, I just have my head exploding right now. So, but don't worry, it'll be ready. It'll be ready for the next explosion. I'll put it all back together.
All right. Yeah, and like I said, if in the meantime you have any questions on anything I ran, I was speaking a foreign language at times, I'm sure. I remember when I first tried learning about whole life, and it took me a very long time, but I promise you, this becomes second nature. But in the interim, any questions you have, please refer to my contact information, and reach out to me. Was everybody able to see that in the chat?
Yes, I had one question though.
Mm-hmm.
So I was actually looking at writing a policy on myself, and I already did my app,
Mm-hmm.
and I did the GIO writer, and instead of the GIO plus. And when I was looking through the manual that kind of goes over it, it said that they had the same option dates, but you were saying that the GIO had just 3, 6, and 9. So I was.
You know what? That actually,
I didn't know if that changed.
No, that actually might have actually changed on me. We've gone back and forth on the GIO rider for a while, and here's another nice tip. Anytime you see this, and you see this handy question mark, what it's going to do is open up a side piece here.
Yeah, it looks like it was in the writer manual on the.
Yeah. So what they did. All right. So for the last series of contracts, they go back on GIO and GIO plus. So keep that in mind, and thank you for that, because I had not even noticed that. So awesome. What we're looking at is GIO plus. We've gone back on the last 3 options to the way it is now, to the way I thought it was, to the way I incorrectly told you it was, to the way it is. So we have a few different ways of doing it, so forget everything I told you. Thank you so much for that. And what it actually does is going to just have to do with waiver. So the GIO plus is going to need the waiver on that contract. And if we're disabled when a GIO option comes into play, we'd be able to exercise that option and have waiver of premium on the contract. The regular GIO, we don't necessarily need to have waiver. We can have waiver, and for younger people, I would tell you, put waiver on it one way or the other. But we'll be able to add waiver onto the new policy in the event we're not disabled. If we are disabled, we can still exercise the option, but we're not bringing waiver over. So you are absolutely correct. I was absolutely incorrect. If we looked at the old version, then we would see that crazy version I'm talking about.
Dennis, I have a question.
Mm-hmm.
You talked about the term with the rider that turns it into like a paid up whole life. If I heard that correctly, and like, how can it do that? And why isn't it just a whole life if it's doing that? Like, I don't understand. Or is the rider hideously expensive?
Well, we're talking about the Q term, this last one we went over?
No, in the beginning when you were going over some riders in the term policies.
Oh, so were you talking about the RTR?
Yeah, it's like is that what, I don't know, but I just remember you saying that they can have this rider, and at the end of that term, they can keep it as a paid up permanent policy. No? I didn't hear that right?
Oh, so that was on the Guardian level term with the waiver plus.
Okay.
So what it does is, if we have extended conversion rider, so that would allow us to convert the Guardian level term for all years in which it's for its full duration. So whether that's 10, 15, 20, or 30 years, and we have waiver plus, assuming I have that GLT 20, and I have the extended conversion rider and waiver plus, if I'm disabled in the 10th year of my policy and I'm permanently disabled, I would have 10 years remaining on that term, right?
Mm-hmm.
Those 10 years would be paid for by Guardian, so I wouldn't have to pay that term premium out of pocket. But then in year 20, instead of my contract just going away like it would have with the regular waiver, it converts into a whole life contract with waiver attached. So I suddenly have a whole life contract with waiver, and Guardian is still paying my new whole life contract premiums.
Okay, so you have to be disabled and use the waiver of premium as a result. But that's pretty sweet. Like, oh my God,
Yeah,
I bet it's
absolutely.
Is it expensive?
Oh, it is going to cost you more than the regular waiver. Now, that being said, compared to the regular waiver, it is going to have a significantly higher premium.
Okay.
Now, when you take into account it's the potential it has there, I think it's worth it. But that's why I said there isn't any right or wrong waiver. A lot of it's going to come down to budget. A lot of it's going to come down to family history, how somebody feels about their potential to be disabled. There are a lot of things that are going to come into play, and that's why, if you ask me which one is right, waiver plus or waiver, I can't really give you an answer because it would really be on a case-by-case basis. Now, that being said, I think it's huge that we have waiver.
Yeah, that's cool. Thank you.
No problem. All right. But yeah, like as I said, if any questions come up, please do not hesitate to reach out to me, and and we'll have a couple of more sort of in-depth things as we move forward, and some different ways of running some of these illustrations and some different concepts. But in the meantime, like I said, I know I went over a ton of information. I also sometimes speak incredibly fast, so please do not hesitate to reach out to me and ask me any questions you may have.
Thank you, Dennis.
All right. Have a good one, everybody.